So here we're back in first presented fair value gap. Okay, so we have minor buy side here, and we have the opening range gap low, which is at opening price at 930. So we haven't even traded at all in that since its opening candle. So I don't count that little bit of price action here during the first minute. That to me is of no importance. So what I'm looking for is the willingness to want to get above this high. Then we're in regular trading hours opening range gap. And then the liquidity inside that gap, the closest one is this here. Okay. First presented fair value gap. Okay. Since we pulled up into this, you got to give it the opportunity to perform as a potential inversion fair value gap. Okay. So in other words, we had a little bit of sticking its head outside that range there, defined by that volume imbalance there. So far, we haven't had a body outside of that, but this is the liquidity inside the opening range gap. That's the buy side. Holding a bear stance, trading down and then coming up into inversion fair value gap with bias. If it wasn't rather, Friday, say this was Thursday, I'd be all over this shorting it. But because it's Friday, I'm a little reluctant to trust this going down. It could take that low. I'm personally not willing to see that at the moment. I want to see, do they have any real interest to take that first 930 candlesticks high out? If it does, if it can do that, then the liquidity resting over here, that would be the draw. And that's during the pre-market session hours of 7:55. So I'm not trusting it here, even though I do hold a bias that's bearish. It's one of those setups where I would just let it go. I wouldn't do anything with it. Why am I saying that? Well, because we opened right up at the high of the regular trading hours session. So regular trading hours is this. So we opened, that candlesticks is the high. So if we would have traded, even if it spiked above it and got that high taken out just by one tick, and then it went down in here and started acting like this, then I would look for lower prices and continuation lower. But because it hadn't done that, it makes me reluctant to do that on a Friday because we're up against TGIF. And while I don't believe we're finished going lower on an intraday basis, this range, it could trade up into that buy side here, which you don't see the candlestick here, but that's that 7:55 1-minute candlestick viewed through electronic trading hours right there. That's that. So in and of itself, this is enough to see it go lower. But that's not a trade I would take personally. Let me borrow this line here because we just took another low out there. See this candlestick low here and this candlestick there? That small little gap there, since we took that liquidity pool one more time, we created a low, broke lower. A lot of you guys that trade these breakout strategies, there's a lot of people wanting to be short now because of that. I'm not arm wrestling on you, okay? I'm just saying that if we can get above this little area in here, okay? So if we get above that, then we can return back into first percent to fair value gap. That would be something that would be cool to watch. All right, so we went a little bit lower. We've had a sell-off rate from the beginning, retracement into first percent to fair value gap, new lower low, and we have this gap right before it took that liquidity. So let's see if it has any interest in getting back up to that at all. It's 10 o'clock news now. See this little gap here? If it wants to climb a little bit and get to this gap that happened right before the sell side was taken, we would want to see it try to get above this. As long as it stays below it, lower prices are likely, but we would want to see this type of thing happen here. So far, it's hit consequent encroachment there, and it's doing as it should. Now watch that volume imbalance right there to the consequent encroachment of this wick. Bearishness gets a body closed below the midpoint of this wick. If it can't even get down there and it trades back above here, then we would likely see it trade up to this level there. So we traded down to a higher time frame daily level. We colored outside the lines a little bit, and we're showing a willingness to go back up higher. Now we're at kind of it's like a measuring stick or a gauge on determining the the likelihood of continuation. Challenges, you're not trying to get to your payout. Okay, you're not doing that here. Okay, when you're brand new and you're looking at things like this, you want to measure the willingness of what price is willing to do at key PD arrays. We had this low taken out by this run here. We traded down to the low of that daily PD array, which I'll go back to the chart in a second to show you again what this range in gray is. But to have the this level here, the bodies are showing. If you were bearish, you're seeing exactly what you would like to see. But I'm suspecting that it's not likely to continue only because we started out the gate right away lower. First business fair value gap delivered beautifully. Traded down to the low of that daily discount array. So we colored outside lines of it just a little bit there, and then we rallied up a little bit. The body stayed outside of that gap, and I told you to watch that volume imbalance there to the consequent encroachment. It went right down into that, overlapped it a little bit, but now this opened right below consequent encroachment. If I was short, say I was holding a bearish position, I would not want to see it leave a body in the upper half here. Would not want to see it at all. I would not be willing to see that. So if I was short, I would have trailed the stop loss, and I'd be just about right here above this candlestick's high. That's where the stop loss would be if I was short. Because if I'm getting stopped out there, chances are it's going to go higher, maybe to this inefficiency, and I don't want to open up myself to larger risk. But if I'm bullish, or if I'm anticipating a run to this level here, or maybe trade back up into this sell side imbalance, buy side inefficiency, consequent encroachment, that point up there, I would want to see it trade into this area here and lay down a body and then go outside the upper half of this, just even a wick alone. And then we would want to see the lower half not trespassed upon and just then run up into this area here. It's tape reading. That's all you're expected to do when you don't know what to do yet. So daily chart real quick. Remember that gap I just showed you earlier? That's where price went down into that. Okay. The next order of business is down here. We do have that consequent encouragement there. So say for instance that we resume going lower in the latter portions of the day going into the close. That might be a draw, and they may leave this intact, not trade through it, on a Friday. But down here, consequent encouragement, that wick right there, that's definitely a level you want to have on your charts. If you're short from up here, like we were talking about, you want to be considering that maybe as a partial. So here we got the market trade above. Now watch. If this is bullish, if they want to make a run to take out, say, the 930 opening candle, and that's like right here, right there. Watch the price action in here. This is okay, but you can't leave bodies in the lower half of that. Can't do that. They'll get this inefficiency here. This has not it has not acted as inversion yet. Say this is the rock surface that you're standing below the base of. Okay. Here's the part at which if you climb to that high, that's the goal. So this is the range you're inside of. And whenever you're looking for things to tape read, to practice, what you're trying to see is what signatures are in play right now based on what you're watching in price action. Let me put this consequent encouragement on real quick. The this range there, half of that would be, where are we at? Low to high. So we traded just above. So we went to a premium, but failed to get into this inefficiency. So note that. By itself, if it were Thursday, not Friday, I would be selling more here, looking for that low to be taken out because it didn't get to this one here. I'm still leery of that. So I'm looking at this here as a low day for right now to see if the evidence around these levels here can support the price. So far, it has not acted as inversion fair value gap. So since it's moved above it, now we went down below it. If it can climb outside of it here, then the criteria is this stays kind of like a no trespassing. You can't leave a body down in here. This painting back and forth, this is the part that people think, oh, they don't work. It doesn't work. You have to have the understanding of what it is it's supposed to be doing. By it trading above it here, that's wonderful. Now it becomes, now you can watch and see, does it give you the scenario? It validates it by taking it out on the downside. So what has it done by doing so? It trades above it and below it. So now this takes on the characteristic of a balanced price range. That specific candlestick right there. That's what it's doing. That's the function. Okay. When the algorithm refers back to these levels, it uses scripts and logic to support price or reject at those levels. We went below it here. So now we've done two passes. We've done buy side delivery, not liquidity. That means just movement through a range up. Then it had sell side delivery, which is movement simply going lower. So now if this PD array is valid, and it should act as a inversion fair value gap, that can only be done now if it trades outside of it. And then any movement back down into it here needs to support the idea that it's not going to be willing to lay a body in the lower half once it leaves the upside of it here, this part here. This is not enough. It's got to do it on a body basis. It's got to close outside of it. That's inversion fair value gap. I'm going to compare um, the S&P with these highs right here, okay? See that? That's a little S&P divergence right there. NQ. It could stab down there and get that consequent encroachment of that wick. See the bodies on the low of that right there? So right now it's still operating underneath the idea of a reclaimed bearish SIBI or sell side imbalance spot side deficiency. When you're tape reading, you're not trying to hold yourself to being right or wrong. You're just trying to collect information on how price reacts off of specific things. If it can close below consequent encroachment, that would be indicative of likely make another lower low. If it takes out that low, then we're probably going to stay heavy the rest of the day. There's a lot of things in this price action already that's one-sided. The fact that we came up in the first position, very bad gap here, beautiful, nice sell-off there. We failed to get to this inefficiency. So that is what? That's weakness. We had S&T between ES and NQ here. Sold off, but we're up against this big wick and net volume imbalance. So what is that? Taking two ranges, small little gap here, volume imbalance there. We trade up into that. It would need to sell off this candle or immediately the next one to get below consequent encouragement if it was bearish. Like say, for instance, I was short. Based on what we're seeing here, it would need to get real animated to the downside here. All this line here is simply just measuring premium to discount. This is equilibrium right here between this high and that low. If you watch that, see the red line moving around? That's just anchoring to midpoint. So we went to a short-term premium here, traded lower. I would be a little nervous if I was short simply because it's spending way too much time in this range. I would want to see it get real aggressive to the downside. But what happens if it just sold off and went down another 300 handles? It wouldn't bother me. I wish I would have done this. I wish I would have done that. Because I have protocols. I have things that tell me this is a condition, this is a market environment that is conducive for me to potentially be wrong. I want things to be in my favor. We're inside high resistance right now. Is it running? It's spending too much time in this range. I don't like that. Despite the fact that it couldn't get to here, despite the fact that we poked outside of this here and we use it as a continuation of a reclaimed bearish fair value gap. Even though it's done those things, even though that we had this little movement here in this SIBI trade up here and move lower, the fact that we have not ripped down below consequent correction of that wick, that to me is indicating, it's signifying I'm not interested and I wouldn't be a part of this move anymore. So because of that type of stuff, whenever I'm seeing a lethargic price action, when it should be delivering, like right now, there's no reason for this thing not to start careening towards that consequent encouragement at red level now. Everything's in play. Everything that you would expect to see in price action. It needs to drop here. If it fails to do so, that to me is problematic for being short. And if it's not likely to go lower while we're in the lowest portion of the daily range during regular trading hours, that means from this candlestick's high down to that candlestick's low. Where are we at? We're in a deep, deep, deep discount. And when you're short, or if you're trying to get short, you don't want to be getting short like this because it's already pressed down so deep and you want to see price really take off if it's going to be bearish. And because it's not trying to do that, to me, it causes concern. It doesn't make it feel obvious that, I should be in there taking the trade, or if I was short that I feel comfortable. I would be thinking to myself, okay, should I be taking off partials? Should I be doing something in terms of taking some of the position off when I see those types of things? Now get below that and close. All right, so if it closes below that line, then a sustained price run below that low is in play. One more touch to that daily fair value gap and efficiency on the daily chart. We showed on when we were looking at daily. Now, if it wants to continuously go below this low here, what I'd like to see is this portion of this gap here. I would like to see that stay open. If it can stay open and trade below that low, I like to see those types of things in price action because it's showing potentially a breakaway. But if it comes back up and closes that in, I don't like to see that. So in your notes, um, when we're in on a Friday and we're looking for a low, even though we're bearish, or let me rephrase that, even though I'm bearish long term, intermediate term, moving below old lows is always a welcome thing. That's the direction. That's what we're looking for. But if it's doing so in a manner where it's on a Friday, it's been one sided right from the opening. If it has these little gaps like this and it fills in that gap, I don't like that because two things can happen. Number one, it can trade above this here and use it as support to go higher, or any run below that low could now be stunted. In other words, not see a whole lot of continuation below it. It can, but it's more likely, in my experience over the last 30 plus years, these types of scenarios, I'd rather see them stay open and then go below that here. And then everybody else would expect it to trade back up above this low to get to that gap and then go short. That's not what usually happens. Think about think about what I've already said to you about how picking fair value gaps. What are we anticipating here by being bearish? Well, if we're bearish, we would want to see this low get taken out. So a fair value gap, before it does that, what have I been teaching you? They act as inversion fair value gaps. So now you understand the logic, okay? See how much time they're spending inside this gap? That's also, I don't like that either. And we're at the low end, we're at the lowest point of the range. So there's your regular trading hours range for today, okay? We are in the lowest portion of it. We came back up into this gap here. I don't like that. Even if it takes out that low, I don't like it. So what we're going to watch and see is if we can take that low out, even by one tick, does it melt and go lower and accelerate to the downside? Or do we enter back inside the range that's shaded here? A drop below this should not see it return back inside the range. It should break below that. If it's really bearish, it should break below that low and accelerate down with a lot of energy. But if it just goes below it by a little bit and then wants to quickly get back inside this range, it's like a little dog on the porch. Okay. And it runs off the porch and starts barking at another dog on a leash. But that dog on a leash is a kind of corso. And it turns around and tells that little dog, hey, get back on your porch. And it runs whimpering back on the porch. That's not strength. That's what I'm trying to illustrate. Where is if it runs below this and takes off, you want that dog coming off the porch to be the kind of corso running after whatever it wants to run after. See how much time? See how much time it's staying in that gap? We don't want to see time distortion inside of inefficiencies. See how many times it's used that little area? Now, contrast that with when the market's really wanting to move. It'll go in there one candle and then it's gone. It leaves. Elvis has left the building. That's what you want to be trading in. Those environments where you have quick feedback. The price action is telling you exactly what it wants to do. It's in a hurry to get to your targets. That is low resistance liquidity run conditions. This, even if it trades below that low, even if it takes that out, this is what I'm teaching you not to look for. Don't look for these types of scenarios. You want them to be, well, when you want to see gaps left in. You want to see portions of price action left there unfilled. That is where you'll have a lot more freedom to see price move around. See what we did there? Just stuck its toe outside the fence. The little chihuahua barking, and where's it back? Right back on the porch. Not good. I don't want to see that. And because we're so far deep in the regular trading hours range of the day, in other words, this, you toggle the regular trading hours. This is the full daily range here, viewed from regular trading hours only. And we're at the low. We're down here at the low of it during a time when what? We're getting ready to go into the lunch macro. So there's so many things leading as a offensive stimuli that prevents price from being quick and sudden and moving for you when you're bearish. Right there, if you're bearish, does this look good for you? Do you look at this and say, wow, this is exactly what I want to see after it took out the low by a little bit? That's what I'm trying to tell you, to look for those types of things. So now watch this here. It can trade back down into that and see, because we went into it here by a little bit and then we went out of it. So we've done two sides. Now, if it trades down into that, price went just below that low in a deep discount. In that gap here, we traded through it, got real close to it, but notice it didn't even touch it. If it can't come down and touch that, but it goes into this one here, if it trades up into here, then we probably made the morning low, and then buy side right here is the lunch macro. And this is all that you're expected to do when you first start. It's very forgiving. It's observing. It's weighing out things. What does it do now that it's created this? What does it do when it creates that? Is it able to overcome this level? Is it able to move quickly away from this level? Look at the time of the day it is. It's all of these types of things that you're trying to cheat yourself from learning. Now, you see these things like this where it drops down. We're going to see that as a continuation pattern, retail. And I told you, watch this low. Okay, if it trades below that, it might fail. Why? Because it spent so much time in that gap right there. And we couldn't even touch that. That's bullish. I told you it would run into this. Look how fast we did it. We opened here on this candlestick, traded down to the low end of that, and couldn't even touch the low. Watch this candlestick's high. Watch and see if it wants to do it here. In a perfect world, if it wants this right here for the lunch macro, taking that buy side there, it won't lay a body down in the lower half. It can, because there's a small little inefficiency right here. You see that? That's why this is okay. But if this wasn't a gap here, I would want to only see it trade into the upper half. Wick in the lower half, that's fine, but not lay a body down. But because this inefficiency is here, it can trade to its consequent encroachment of that and then leave a small portion of this gap here. Show me how to get into a trade that works. You have to know what is indicating that the market's not likely to deliver specifically. You have to have protocols and processes and things that are they're defensive mechanisms, because the market's going to go this direction. 99% of you are looking in the rearview mirror and saying, wow, prices already did this. So I guess I better go long. And what I'm teaching you is how to interpret price action right now, live, and the barriers and where you need to have a detour, because sometimes the pothole forms right when you went over top of it. And now what do you do? That's the reality of market trading in real time with real risks. You have to weigh all that stuff out. Down here, when we were looking at that low, this is a potential hazard. So anticipating a price run below that low when we're so deep in a discount from the first candlestick at 9:30, you have so many things against you in and of itself by itself. Then it's Friday, and it's been one-sided from an opening bell at 9:30, and then we start seeing fair value gaps here form. There's benefit in knowing when they're not doing what you think they should do. If I have a PD array that I'm watching, if it's not performing in a manner that I expect it to perform in, that's intel, that's insight, that's giving me a means of measuring real order flow. I can see whether or not there's a willingness to support the run continuously from that level or not. When the markets are operating, you're watching price action. You're weighing out all these things and seeing, does price support this idea? Does price negate this idea? Is this PD array indicating something to me? And you watch and observe and you study it. The fact that you're doing it right now when the market is hard, and anybody says it's easy right now is a lying piece of shit. It's all clout when they say that. They're trying to make it seem like they know everything. In this environment, I don't know everything because there's interference constantly coming in by our president. There you go. I said it. Range. I thought that was this. Watch. That was the initial one here. So now we have this. Okay, so there's your mid range, okay, or equilibrium of regular trading hours range. We didn't trade to it here yet. Below this gap, and we're spending too much time inside this gap here. So it could drop back down in here and touch this. I prefer it not to do that, but simply where a fair value gap forms inside of a present narrative, time of day, day of week, uh, the market structure that's in play. In other words, where are we at in the range? When we were down here, and I was telling you, watch that low. I'm not looking for that to go down there and accelerate. It could. I could be wrong. And you could have watched me be wrong about it. But the things I was teaching you, that's the benefit of learning from a mentor. My experience, I lent it to you and told you that these are problematic things for a continuation going lower because we're all one-sided right from the beginning. And the time of day, 10:30 going to 11 o'clock, that's usually the macro during lunch hour. And that simply is from here's 10 o'clock. So when we're here, where is liquidity going back to 10 o'clock? What's the first short-term high? This one right here. So macro for lunch is retrace back to that. Now it can take that high and continue higher, or it could take that high and go lower. That's not the macro at lunchtime on a Friday. You're not concerning yourself with that. You're just simply expecting it to do something like that as a observation to study. That's all. That's all you're doing. So here's that fair value gap that formed right before that sell side was taken, right there. Okay, what have I been teaching you? Use this one as an inversion fair value gap. We traded above it here. It couldn't even find its way back down to touch that. That to me is indicative. It's indicating that we have an underpinning of the marketplace where they possibly have a lot of people trapped short here. Too many candlesticks inside a fair value gap. It needs to be one, maybe two at most, and leave. Leave. Urgency is what you want to see in these fair value gaps because if they're valid, if they're very much in the right side of the marketplace, they're not going to waste your time. They're going to try to run. They're going to use that moment, then sharply leave it. That's what you want to see. You want to see that type of thing in price action. You are not seeing that here. You are not seeing that at a low of day when the market was all one-sided. Now think about what we've covered here, okay? We're talking about problematic scenarios, looking at periods where price may do something. It could do it, but I'm not, if you're listening to me, even though it could have went below that low and went significantly lower, I'm not willing to take that trade because of the things I've outlined here.